Good morning, everyone, or good afternoon to those of you on the East Coast. This is Jack Weichsel with East Daily Analytics, and we're going to be starting the presentation in just a minute. While you're waiting, you're welcome to scan those QR codes that you see there and get signed up to a couple of our free newsletters. All right. Well, it's one after the hour, so I think now is as good as time as any to get started. Welcome to our Q1 natural gas focused webinar from East Daily Analytics. My name is Jack Weichsel. I will be presenting to you today for about 30 minutes or so. Alongside me is Alex Gafford. Alex runs a lot of our regional basis forecasting and regional basin S&D and production reporting. We've got a lot of good information for you today. Questions are you can submit through the portal, and we will, if we have time, we'll address those at the end. So why don't we go ahead and jump right into things? Get these slides moving. So a disjointed winter gives way to a volatile 2024. It has been a very disjointed winter, we've seen prices essentially collapse. And part of what we're going to talk about is how long that's going to last. So let's kind of go through a few things first before we get into the subject matter at hand. If you're not familiar with East Daily Analytics, we have a whole suite of natural gas products available for your consumption. We're actually very excited to announce just this week that we've got a couple brand new looks. So the West Coast and the Houston Ship Channel product lines have been released. There's a monthly analytic report available in PowerPoint, and then also a data set, which basically shows supply, demand, production, egress, and price assumptions going out for the next 3 or 4 years in each of those reports. Coming later this month and also in March are the Anadarko, the Southeast Gulf, and the MidCon reports. So again, we're very excited to release this. What this does is it allows us to give kind of full US lower 48 regional hub and spoke coverage of these important basins, and also show the build to our macro report. So yeah, if you want more information, just scan that QR code down on the bottom right. Finally, if you're interested in our consulting services, and I can tell you that we've gotten a lot of interest so far just in the first month of the year, particularly around market studies. Scan that QR code on the right to talk to a consultant. We've got a full our army of really knowledgeable folks here who contribute to these projects, and it's very effective use of funds to get with East Daily on consulting. All right, so that was kind of the commercial piece. Let's get into the meat. Let's start talking about what we need to talk about here for Q1 in terms of natural gas. I guess first point I'd like to make, and this is an extension of what we talked about in our Dirty Little Secrets webinar at the end of December here. We're looking at a second consecutive weak winter and plenty of gas in the ground, and a kind of a low price environment for the foreseeable kind of near-term future, right? What this enables certain facets of demand to do, like power burn, is to really go ballistic, as it says in the circle there. Power burn is going to start going off just as production begins to ease over the next 6 months, and so that creates even more heightened volatility in the market. When do you go from an oversupplied market to an undersupplied market? We'll talk about that transition later in 2024 and how opportunities exist as a storage surplus swings to a storage deficit. And then finally, the 800-pound gorilla in the corner of the room is this looming LNG demand piece of the market in 2025. This is going to have a significant impact on prices, not only in the Southeast Gulf, but across the lower 48. And we'll show you some stuff to do to prepare for the best and worst of it. So what's been happening this winter, just to kind of set the stage, right? Production took a hit following Winter Storm Heather, but it wasn't much of a hit. In fact, we still forecast production this winter to be 3.1 BCF a day ahead of last winter. And it should be enough to cover increases in demand. You see a couple different things here I want to highlight on the demand section of this chart, right? The first is 1.1 BCF a day of incremental LNG demand. Now, this is basically on top of the Freeport outage from last winter. Now I guess one train has gone down at Freeport, but still we're expecting excessive LNG exports versus last winter. And then the thing with the purple circle around it is our ResCom demand assumption, assuming normal weather, right? 1.2 BCF a day incremental. Well, this winter has been anything but normal. And so as it relates to that warm winter, with the exception of that storm in mid-January, right? If that 1.2 BCF a day does not show up, it essentially rises or increases our end of season inventory forecast from about 1884 to around 1925. Some even think that we could get to around 1950 or so. In fact, if you take the average 5-year withdrawal rate from this week's storage number assumption, then you get to about 1969. So heady inventory levels at the end of March, something that everybody needs to be aware of. We use, as part of our price forecasting kind of operation, we use a yield curve, which basically plots the price of natural gas versus the storage surplus and or deficit. The red dots are where we're at currently. So you can kind of see that these low prices have been pretty prevalent over the last 12 months or so. We did see a price pop there ahead of Winter Storm Heather on average for that week. Similar to the same outliers that we saw during Winter Storm Elliott just 2 winters ago. But one thing that was interesting to see is that after Heather, you had that massive 326 BCF withdrawal for the weekend in January 18th. That shrunk the surplus from about 348 to 142 BCF. But the market kind of shrugged. They didn't really care about that, at least in the forwards. We do expect that the surplus is going to expand once again through the balance of winter, barring any major, kind of below normal temperature swings in the month of February. There is a period from about the 17th to the 22nd that looks a little colder than normal, but not nearly as cold in comparison to Winter Storm Heather, which again, the point here is it didn't do very much in the first place. So let's get into kind of our first main topic here. That is, we're going to look forward to and see how this impacts the balance of 2024. We believe that power burn is going to remain kind of on a tear. For winter, it's about a half BCF a day or so stronger than last winter. But in summer, last year at least, it set all manners of records. And you can see the price there, kind of sustained average price in summer 2023 below $3 there. Not to mention that gas-fired power burn has now achieved 47% of generation capacity in the United States. We do not see a case, at least in the near term, where renewables really penetrates the gas stack. In fact, renewables and gas really complement each other very well right now. What we think this does do is leads to more utilization in the summer of 2024, where we believe power burn will average about 38.6 BCF a day, or 0.3 BCF a day higher than that record-setting summer 2023 level. Something to consider here as you're looking forward, right? You've got this excessive power burn, but at the same time, you've also got some pretty significant LNG demand to contend with, even with this minor Freeport outage. This is our post-DOE non-FTA review decision, or the pause, as folks like to call it. This is our outlook. And so post-pause outlook, our export capacity was 32 BCF a day. I guess that would be pre-pause. And when we took a second look at the facilities affected by this pause, that export capacity dropped down to 28 BCF a day. We assume 90% utilization going forward for North American LNG exports, which brings total flows in 2030 to around 25.2 BCF a day, about 3.6 BCF a day lower from the base case. But I think the most important thing you kind of get out of this slide is that in the near term, that DOE pause ruling does absolutely nothing. One of the big things to consider as we look into 24 and 25 is the fact that there is 6 BCF a day of LNG capacity coming online. People like to talk about Plaquemines and Golden Pass a lot, which is understandable because they're going to be the first new facilities built in a couple of years. But what is also coming online in 25 by Q4 is Costa Azul and Corpus Christi 3, which are about a BCF and a half or so of incremental capacity. So you can kind of see that ramp up here as we get into late 24 and early 25 that folks are really going to have to contend with. Just a short note on the pause, right? So the two facilities that were mainly impacted are Commonwealth and CP2. They total about 3.8 BCF a day of export capacity, and that's kind of why we've taken them out of our stack for the moment. One of the things that this pause decision has created is a world of haves and have-nots. If we go out to May 28, and we see another 5.5 BCF a day of capacity that has been FID'd and has also has that DOE non-FTA approval. On those facilities that are listed out there by May 28, there's about 2.2 BCF a day of sales purchase agreements available across those projects. So we may see a shifting of commitments in the space, and we may even see an acceleration of some of these folks being able to start construction as their FID is even more solidified. So just something to think about a little bit long term. We have got more kind of complete analysis of this. So just reach out if you want a full understanding of the pause and its impact on our export forecast. All right, now switching gears to production, right? So this has been a focal point for East Daily for a while. Who gains and who kind of flatlines, right? This is a what we call an entry to exit chart. And so some of the numbers on here we need to pay attention to as net gainers. Some of them are just circumstantial, but overall in 2024, what we saw was a slide entry to exit. Started the year at about 105 BCF and now are sitting at about 104, or we ended December at 104 or so. Overall, though, on average, production was up by 0.3 BCF a day than 2023 levels. As we head into 2024 completely, right, or 2025, right, you've got the chase, right? The chase is on to essentially get that incremental LNG demand. What we expect is that you're going to be led here by the Permian, and then also the Arklatex, which is what we call the Haynesville. It includes some of East Texas. Arklatex has the most infrastructure coming in around it to service facilities like Golden Pass and Plaquemines. We believe that production in December 25 will be up about 2.7 BCF a day versus where it stands right now. Permian will contribute, of course. You got Matterhorn coming on at some point this year, and we believe that that production, at least December on December, will be up about 1 BCF a day. In total, 2025 production is going to average 106.2, up about 2.2 BCF a day versus the 2024 average. So for more information on production, we've got an extensive collection of what we call production scenario tools and production models, where you can actually input your own assumptions around things like IP rate and rig count to really see what your version of production does to both regional and macro supply and demand balances. So that's kind of the production story in a snapshot. Now let's talk about price, the money slide, if you will, right? Here's a graph that we use kind of quite frequently on the right. The light blue line is the storage deficit or surplus to the 5-year average. That darker blue line is a Henry Hub spot price there. So as a frame of reference, you can see that in February 23, about a year ago or so, we had 367 BCF surplus to the 5-year average, and prices were at 238, right? We're not quite that high this February. This week's storage report should move the surplus out to about 254 BCF. And actually prices have gotten a little bit lower, but there is a relationship there. I guess kind of the main point of this story is that when we get to the end of March 2024, that base case forecast of 1884 remaining in storage equates to 255 BCF above the 5-year average. But if you get to 1925 BCF, your surplus surges to over 300. And so that's where kind of the real trouble starts. Let's talk about that specifically and its impact on price. So our forecast, this pink dotted line here, we're looking for Henry to average 259 for this winter. And then if we look further out, we think that the beginning of summer prices will spend a lot of time below 250 before increasing in Q4 as a 5-year average deficit returns. So this is that transition from oversupply to undersupply. You can see here on the chart that dotted line, it's kind of the Mendoza line. By the time we get to October 24, you're 31 BCF under the 5-year average, and that those deficit conditions just continue kind of at exactly the wrong time because you've got LNG demand ramping up, you got production kind of on its heels after a very weak pricing environment, and you can see that that deficit effectively grow out to over 500 BCF. Versus the forward curve, there are some opportunities here, right? Near term, call it April, May, our price forecast is above where the forward curve is. If you're at all adverse to higher prices and you think that the curve could suddenly rise as it realizes its power burn commitment earlier in the summer, which is certainly where we're at, could represent a good buying opportunity. Same thing in the fall, which is currently discounted, we think, a little bit too much there. So all in all, buyer's market in 2024, if you're a producer of gas or if you sell gas, the differential between our calendar year 25 price outlook and the curve is about 50 cents right now. So the curve has not maybe fully considered or appreciated the amount of gas that's going to be needed to serve these LNG facilities. It's not high enough necessarily yet for production to start to really fill in and capture that existing demand and that existing deficit. And so, as far as the curve is concerned, gas in 2025 is still a bargain. We don't share that same opinion. We think that 2025 prices are severely oversold and are waiting for that curve to come up for calendar 25 as a whole. So just to review the price outlook, which I think is why a lot of folks are here. Significant downward pressure to start the year. We believe that the price ramp begins in July as we get cash prices over 255 again. And then we think that we end the year closer to 350 as the realization of that incremental power and LNG demand really kind of comes into full view. In 2025, production is playing catch up as higher LNG export demand arrives. Again, the inventory deficit balloons to over 500 BCF a day, and production is still playing catch up. Overall, we see the average Henry Hub spot price for 25 to be about 390, or 26% higher than 2024. And the upward price pressure really starts to kind of become evident in late summer of 2025, with August being one of the first months where Henry will average for a month over $4. And again, layer in the curve there, right? You kind of see those opportunities that I mentioned before. Certainly that 2025 viewpoint is a little distinct from where the curve is right now. Shifting gears a little bit, I want to showcase Alex Gafford and what we can do on a basis level. So again, we've got Western S&D, we've got Houston Ship Channel S&D coming out in the next, this month, and then followed on by a number of different ones. This is the type of analysis that you're going to see in those reports. We think it could be very useful to our audience here to have Alex kind of run through what we think about Houston Ship Channel basis for this presentation.
Yeah, thanks, Jack. So jumping into the Houston Ship Channel, we're calling for downward pressure on the forward strip, given an oversupply of Permian gas without any new incremental demand coming online through 2027. If we take a step back and look at basis pre-Whistler, which is that red circle there, the area wasn't too interesting as it traded roughly even with small fluctuations with summer demand. Then we had Whistler come online, and shortly after, we had the massive Haynesville production ramp flooding the region with additional supply. This new dynamic resulted in basis as weak as about $1.50 back. We now have Matterhorn coming online this year. We also had Whistler expand and Permian Highway expand, which is just going to exacerbate this issue that we saw in 22 and 23. Luckily, Haynesville pipelines will be online to allow some East Texas gas to be diverted from Houston down through Louisiana. So in that chart in the top right, this shows flows being reduced by about 3 BCF a day back up into Carthage from East Texas. And that's in that red circle there showing flows from East Texas down into Houston. This flow dynamic is going to weaken the basis at both Houston Ship Channel and as well as Carthage and create space for continued volatility in the region. Then, when we look beyond 2027, we start seeing demand come online that will flip the region from oversupplied to undersupplied. This will create what we think an upward pressure on the forward strip in those later years. If you see that green circle in the top corner, as that dynamic flips, we'll see gas coming back into Houston from East Texas, again, shifting that dynamic between Carthage and Ship Channel. That's just a real quick overview, and you can get more details on our view on the Houston Ship Channel with those supply and demand products that Jack mentioned. We update them monthly, and in those reports, we monitor infrastructure, price, flows, and production. And then with that, I'll send it back to Jack.
Thanks, Alex. Yeah, a good addition there. I think it also shows the detail in our work. A lot of times, folks will just say, oh, well, what's going on in the macro? And I'll say, well, I'll tell you what is really interesting is what is going on a regional basis as things shift. And we're going to continue to see shifts, again, heightened volatility in 24 and 25. So just to recap, low prices for the very near term. followed by a ramp in prices caused by summer power burn and production easing. And then that oversupply situation, it's not going to be long-lived, right? So it doesn't take a minute, but to burn down about 500 BCF of gas, especially if your production is waning while your demand is increasing. The real question is going to be, when is that production response? When does that come back into the fold? And we think that Q4 24 is probably around the right time to start seeing that ramp. And by that time, the back half of the curve in 25 should be a little bit more attractive for producers as well. And then finally, we talked about looming LNG demand. We think 2025 is going to be a really big year for kind of installed export capacity, and the impact that has on not only on Henry Hub, but on local basis and spreads. So I guess the message is, stay with us. We're right on top of this market from a macro and micro perspective. And again, if you need anything, you have any questions, any follow-up, we're available. Our contact information is right here. Scan those QR codes to learn about our new product offerings. We're very excited to be able to kind of come out this year and offer you all a complete view of the market. So thanks again, everyone. I appreciate you guys staying on with us, and for however brief it was, we hope you got what you needed. I am seeing a number of questions, but I don't know that I'm going to have time to really get through all of them. So if you've reached out with a question, we will get back to you directly. And of course, our contact information is there as well if you want to shoot us an email. Everyone will be getting a copy of this presentation also. So, take your time with it and let us know how we can help, and we'll be here. So again, thanks again, and wishing everybody a successful Q1, and we'll talk soon. Bye now.